Good morning. I'm Marc Ostwald, Global Strategist and Chief Economist at ADMISI. I think today seems to be a very suitable day for talking Turkey. Let's have a look at what's been going on. Overnight, we have had an enormous meltdown in the Turkish Lira. Where it is on that particular chart is probably largely irrelevant. The fact that we managed to travel from 550 to 625 without so much as a buy your leave, and we're showing strong signs of instability still, is a reminder of how things can go horribly wrong in the emerging market space. And we have been warning about this particular one for quite some time. So what precisely is the problem and what caused this? Well, if we have a look at the next chart, it is an article in the FT which highlighted that the European Central Bank, the ECB, is concerned about Eurozone Bank's exposures to the Turkish market. Specifically, it's concerned about three particular banks: BBVA in Spain, UniCredito in Italy, which is obviously one of the lower ones, and indeed BNP Paribas in France. There is obviously a lot of exposure there, and there is a risk of some contagion. And the real concern on all of this is really when we start looking at the Turkish banking sector's external liabilities and their external assets, which we can do on the next chart. As one can see, it's not a very pretty picture. It really underlines just how much Turkey has been reliant on banks borrowing from abroad to fund domestic lending activities. And we are in this situation now where their external liabilities are so large relative to their domestic assets, and the fact that we've got the Turkish lira only exacerbating that situation, that there is a real fear of a big meltdown. Eminently, this is effectively what we might call a straw which has broken the camel's back. The sanctions introduced by the United States due to the arrest of the pastor in Turkey was certainly exacerbating the situation, and prior to that, the interference by the Turkish government of President Erdogan on the central bank's policies, raging inflation, and obviously these problems with the current account, the fact that Turkey is very exposed to higher oil prices, all make the situation that much worse. So we now have this situation where we have to ask ourselves, well, what's the solution? Well, in the first place, obviously, policy cannot continue to be conducted in the way that it has been in Turkey. However, we do also have to consider in all of this, we can't just stick to the economics of it, we also have to consider Turkey's geopolitical position. And obviously, an unstable Turkey in a region where there are tensions with Russia, obviously, there are all the problems that are going on in Syria and Iraq. The idea of having political instability in Turkey is something which is obviously highly unacceptable. But how do we get around this? Well, in the first instance, I think Mr. Erdogan is going to have to eat humble pie, even though that's not necessarily his favorite meal of the day, and let the Turkish Central Bank do something to arrest this decline. 400-500 basis point rate hike might serve as a stopgap, but that's not going to be the solution in the long run. Eminently, something needs to be done about improving the liabilities of the banks, making them far more internal than they are external. There is a risk, one would have to say, of some form of default here, simply because now, when the banks come to refinance their dollar liabilities, it is questionable whether anyone will actually want to refinance them or roll over their existing financing lines. The IMF is obviously a port of call. Backing down on the whole issue with the United States would be another one. And then we have to see exactly what the fallout's going to be. And in that respect, it's worth having a look at Turkish interest rates. Obviously, they've been climbing and climbing and climbing. 20.69, the average yield as measured by Barclays Bloomberg Index. On the next page, really just to highlight that we've got an absolute sea of 19s, 20s, 21s in terms of interest rates. Forget the external problems that they might have internally. The refinancing costs are obviously prohibitive, but they'll have to be worn in the short run. So what have we got in terms of fallout? Well, clearly, because the ECB made those comments, it's unsurprising, as we can see on the next chart, that the currency in the developed world, which has taken the biggest hit, is the euro, down to a fresh cyclical low, or down in this down cycle. It's hardly a major sell-off, but nevertheless, it does put some pressure there. To some extent, probably the ECB won't be unhappy, given it should give a little bit of a boost to inflation. And on the other side of the coin, we all obviously have the Japanese yen once again in its role, modestly, one would have to say when one looks at that chart, as a safe haven. The big question now is, for the losses that have been incurred in Turkey, and I'm assuming the situation isn't going to improve a lot in the very near term, what happens? We obviously have some lessons here from the Thai and Russian crises of 1997 and 1998, whereby the big problem in terms of contagion was that the losses needed to be covered, and they were covered by people liquidating good assets. And that's the symptom, or the phenomenon, that we need to now keep a close eye on, along with contagion to other emerging market currencies.